Welcome to It's the Economy. Actually, we are focusing on the Q3 results preview. We are starting with the banking sector. Now, if you looked at the Reserve Bank data, one of the problem areas is that loan growth is very good. If you looked at the Reserve Bank data as of December 15, loan growth is 12% year on year, but deposit growth is only 9.4%. You know, that creates a problem. When your loans are growing faster than your deposits, what happens is banks also borrow from the wholesale market, which is always more expensive than their own deposits. And therefore, that will have an impact on margins. This is called the loan deposit ratio. When that is, loans are like 80% of deposits, it creates a problem. After all, banks can't lend everything. They have to set aside for SLR, set aside for CRR. They have to keep liquidity coverage ratio, keep loans, keep money in government bonds. So having a lower deposit growth than loan growth can create problems later on. But the important point is RBI has not done any warning so far. The other thing to worry about in the bank results is that all those 125 basis points of rate cuts, the last one came in December, all that will crunch margins because they immediately make loans cheaper. But deposits take time to become cheaper. That would be another issue to watch out for in the results. But the most important thing will be asset quality. For all these questions, I'm being joined by Rikin Shah. He's the Senior Vice President, IIFL Capital. Rikin, good morning, and thank you very much indeed for joining us. You know, my first dissonance is when you look at the Reserve Bank every Friday data, you're getting a very big loan growth number of 12.5 and a smaller deposit growth number. But if you looked at individual banks, then the deposit growth is almost as good as, for instance, HDFC Bank, advances 11.9%, deposits 11.5%. Axis Bank, 14.5%, advances, deposits even better at 15%, I mean year on year. So there is a dissonance. Is it that some of the big banks are not, bedeviled by this problem that deposits are slower than advances?
Okay, thanks, Latha, foremost for having me on your show. So to your question, what we are seeing is while the deposit growth is reasonably strong for the large private banks, this is the PSU banks where the wedge between the loan and deposit growth is almost 300 to 400 basis points. So most of the PSU bank prints, you would have noticed that the deposit growth has been broadly around 10% or even lower than that for many of those folks. And hence, what we have been seeing is while the large private banks have been ceding loan market share, they have been continuing to gain deposit market share in the last few years. And for the PSU banks, they could continue with this faster loan growth even when their deposit growth has been weaker, simply because their LDR starting point was much lower than the private banks. But as we speak today, some of the PSU banks' LDRs are also now closer to 85%, where the large private banks are. So incrementally, from a 1-2 year perspective, the PSU banks will have to support the loan growth via increment in the deposit mobilization. Else, this growth may not be sustainable for some of the PSU banks.
Okay, a policy question. You know, RBI was aware on December 6th that loans are growing much faster than deposits. But they did not come with the old warning that, oh, LDR is very high. So should we assume that Reserve Bank has been liberal in many things, that they are now more tolerant of a higher LDR? Because anyway, banks have got a lot of liquid cash lying in government securities.
So firstly, one of the reasons why we have seen the LDR moving up across the board in this quarter is because the CRR was cut by 100 basis points from September onwards. So the consequent freed liquidity was deployed into the loans without being deposit mobilization. So that's the first reason. And incrementally, what we have observed in the last 1 year is that the focus or emphasis on LDR has been gradually reducing. And hence, the focus has been more on the liquidity, LCR, and hence, we have not seen that kind of statements or the nudge to the banks to bring down their LDR as rapidly. Of course, we don't want the banks to be wholesale funded over a longer period of time. So after a point in time, deposit mobilization is absolutely critical.
Fair enough. Even as you speak, IDFC has announced a cut in its savings bank rates, but largely for the larger ones, above 10 lakh, above 1 crore, but substantially bringing down the cost of deposits for themselves. Okay, Rikin, what about margins? Would this be better in the current quarter? because some old deposits would have got repriced, or are you going to continue to see pressure on margins?
So this quarter, we are actually expecting some divergence in the margins. Broadly speaking, margins should hold up, and we could actually see some expansion in this quarter because of two reasons. First, the CRR has been cut, so those assets, 1% of NDTL never earned any money for the banks. Now they are deployed to the loans, so you make better yields on that. That's number one. LDR has moved up, which is number two. And number three, the residual repricing of the term deposits is also happening with a lag. And hence this quarter's margins should be reasonable. The December 25 basis point of repo rate cut that we saw, the impact of that will largely be felt in the Jan to March quarter for QFY26.
Okay.
And expecting the banks to report NIM expansion of anywhere between 2 to 10 basis points. Of course, there are a couple of outliers where we can see some NIM contraction as well. But broadly speaking, this quarter NIM should hold up well.
Okay. Well, I know you resist taking the names of individual banks, and I have your latest report where you have said that your top buys include Axis, ICICI and RBL, and you are also positive on SBI and Kotak. You have brought down Federal Bank to add from buy earlier. There is a noted absence of PSU banks in your list. Would you consider adding more PSU banks simply because there have been some advantages? PNB numbers were good. BOIs is improving, even if not the best of numbers. Will you consider adding more PSU banks?
So we like SBI among the PSU banking pack, and we have a buy rating on that, and it is also one of the picks that we have been recommending to the investors. The limited point on preference for the larger private banks over PSU banks is twofold. Firstly, we expect the larger private banks to deliver almost 20% earnings CAGR in the next 2 years versus PSU banks who could be at low double digit at best. The main reason why this is going to happen is that PSU banks' loan mix is largely anchored to MCLR benchmark, where the repricing happens with a significant lag versus the repo linked loans. So in next year, when you see the margins starting to recover for the sector, PSU banks will lag private banks. And in fact, if you look at the RBI data, which comes out monthly, it's already showing that private banks' spread expansion is better than PSU banks. That's number one. And second, PSU banks are no longer trading at distressed valuations. Most of them are now closer to and price to book. And from here onwards, you will need further positive surprises on earnings, which we don't see. So we like SBI among the PSU bank pack, but have a better upside potential in some of the private banks like Axis and ICICI.
Okay. Some of the mid-sized banks also reported some very strong numbers. I mean, Bank of Maharashtra obviously comes to the mind because it's consistently been reporting, and even now, this time advances growth is 19.6%. Central Bank reported very good numbers. Coming to non-PSU mid-sized banks, AU Small Finance has been an outstanding performer, 24% growth, and now it's, of course, no longer only an SFB. It's a universal bank license on the way. Would you consider more mid-sized banks in your list?
So RBL is what we prefer in the entire mid-sized banking pack. We think the infusion by Emirates NBT is going to be a game changer with significant credit rating upgrades and consequent funding cost benefits. So that's our top pick in the mid-sized banking pack. Of course, there are a couple of other mid-sized banks like AU Karur, which are also good banking franchises. But the top pick within the mid-sized pack is RBL for us.
Okay. Well, let me now come to another very interesting report you brought out 2 weeks back on credit quality. You have based it on the CIBIL and other, credit scoring company data. One of the things about the Indian banking sector now is it's not really a corporate lender, it is more a retail lender. So what is your estimate of this retail and MSME loans? Is asset quality as good as the overall numbers indicate? The Financial Stability Report indicated, very good asset quality. How is the retail asset quality looking like?
So if you look at the total retail plus MSME pool in India, including all the categories of lenders, it's almost a 200 trillion rupees market. And what we have been saying is the retail plus MSME has been growing at a healthy 17-18% clip YOY. And now within that, when we look at the asset quality for individual segments, some of the very interesting trends, which I'll just like to quickly, summarize. Firstly, if we start thinking about MSME, where there has been a lot of worry given a runaway growth, tariff-related issues, etc., what we have found is that for the banks, the asset quality in MSME segment has always been benign, and in fact, it is improving as we speak right now. But on the other hand, for the NBFCs, the asset quality within MSME has been deteriorating. The worry more so is at the lower end of the MSME, which we call as micro segment, where we are seeing some deterioration. So that's point number one. Point number two, if you look at the affordable housing segment, there is actually a confluence of weakening loan growth and deteriorating asset quality, whereas the prime housing segment is holding up very well. So affordable housing companies are seeing twin pressure, both on growth and asset quality. Thirdly, if I look at the only retail loan segment where we are seeing some deterioration on a sequential as well as year-on-year basis, is the auto loan segment. We are talking about the new cars, etc. But even within that, what we are seeing, the stress is pretty broad-based across geographies and more so focused in the small finance banks. The private banks and PSU banks are still holding up well even on auto loans. Fourthly, if we look at personal loan segment, personal loans, we are clearly seeing signs that it is turning the corners, both in terms of growth and asset quality. So the personal loan segment, which used to grow at 20-25% in the past few years, had come off to single digit. Now it has started to recover. And we think that the banks will start talking about improvement in personal loan asset quality in the coming quarters. Fifth, on the credit card side, on the credit card also, while the asset bucket delinquencies have started to improve, the net card issuances are still degrowing, and that's a big problem. So the growth is still not returning in the credit card. There are various reasons for that, but asset quality has started to stabilize in credit card. And lastly, if I talk about other consumer durable and two-wheeler loans, that's the only segment where NBFCs are faring better than the private banks, both on the growth and asset quality. So if I were to put all of this thing together and summarize, I would say that the overall growth is actually healthy at 18% in retail plus MSME. And asset quality, there are only few pockets where there are certain concerns, but more or less it has been holding up well versus expectations of deterioration.
Okay, that's a very positive statement coming from you that the retail segment in growth terms is growing at 18%, a very good number. And asset quality worries are what? You said micro loans and a little bit of affordable housing, not really very big sectors. So that's a very big clean chit coming from an expert viewer. Thank you very much, Rikin, for putting in perspective and preparing us for the results, the banking results that are due from next week. Wrap up on Bazaar on that note. Chartbusters coming up.